All four stocks we talked about in our last video turned out to be winners. Today, we're back with the latest updates and what you should do next. Let's start with everyone's favorite, Tesla. This week, on Friday, Tesla had a mini breakout, jumping 4.7% to close at $298 and smashing through a key technical resistance, the 200-day moving average. That level is like a bull market express lane. Crossing above it shows renewed investor confidence. It also marks the highest close in several weeks. Since hitting a low of $214 on April 7th, Tesla has quietly rallied 40%. So it's not out of the woods yet. Before robotaxis hit the streets, optimism hits the market. After Tesla's Q1 earnings on April 22nd, analysts were surprisingly positive, even though the report itself was, well, pretty ugly. Profits fell 40%, missed expectations, and the company dropped its delivery growth guidance for 2025. But Musk did what Musk does. He talked a big game and brought investors back on board. He promised to refocus on Tesla and teased the launch of the Model Y robotaxi. People got hyped. He said the robotaxi would launch this June in Austin, Texas, starting with just 10-20 vehicles. Still, they seem unsure what the final design will even look like. What's a robotaxi, and why is everyone so hyped? In short, it's a self-driving ride-share car. You'll use an app to hail a ride, and the car comes to pick you up, no driver. It's sleek, but the real excitement comes from the business model. It's a cash machine. Once a car is in robotaxi service, it can earn money 24/7, way more profitable than just selling cars. Software equals high margins. Think subscription revenue and platform fees instead of low-margin hardware sales. First mover advantage. Whoever builds the network fastest could own the market like Uber in its early days. But there are some big hurdles. 1. Tech challenges. SSCD full self-driving is still in beta and full of bugs. AI handling unpredictable real-world situations is far from perfect. 2. Regulation is a mess. Rules vary by region. Some places don't even allow level 4 autonomy yet. Texas might be friendly, but scaling this globally is a huge task. 3. Launch scale is tiny. Starting with just 10-20 cars? That's like opening a restaurant with one item on the menu. So what's the investment case? Short term. Technical breakout plus robotaxi hype equals bullish sentiment. Even a small June rollout could bring in retail and tech-focused investors. Medium to long term. If there's no meaningful progress, no expansion, poor user data, or accidents, this could backfire. In the end, it's all about profits. Bottom line. Robotaxi is Tesla's future and Musk's charisma amplifier. It's great for short-term trades, needs real proof for mid-term, and the long-term depends on whether it becomes a real business. Next up, Palantir. We advised trimming before earnings when the stock was near its $125 target. It dropped 12% after earnings. Palantir, hit by Doge and tariffs. Can the AI king stay on the throne? Palantir feels like a well-dressed guest who got bitten by a dog. Doge and stopped by a taxman on the way to a gala. Still elegant, but with torn pants. The good news? Q1 beat expectations. Q2 and full-year guidance look strong. Palantir is still on the throne, but investors are extremely picky these days. Even a small cough can tank the stock. 1. U.S. government. Revenue from Uncle Sam rose 45% year, though it dipped a bit. Despite worries about defense budget cuts, AI is still a top priority. Oh, and Congress just proposed a $1 trillion defense budget for 2026. So much for belt tightening. 2. Europe. Government revenue jumped 46%, matching the U.S. Why? EU countries realize they need AI, and Palantir is the best not-to-American option. 3. International commercial clients. This is where things fell apart. Revenue dropped 5%. 2 reasons. Europe's economy is weak. Companies cut spending preemptively. Data privacy fears. Some don't want US-based firms handling sensitive business ops. 4. Profitability stays strong. Palantir is spending big on AI, but still has a 44% adjusted profit margin. That's beastly compared to most SaaS peers. 5. Raised guidance. Q2 and full-year targets were raised again. US biz now makes up 71% of total revenue. 6. Forward indicators look solid. 51 new customers, big contracts, strong backlog, all signs point to healthy demand. So why the drop? One word: valuation. The stock hit a nearly $300 billion market cap with a forward P/E of 160. That's rich even for AI royalty. Summary: Palantir's product is strong, government love is real, and long-term potential is there. But the international commercial dip and high valuation limit short-term upside. Expect some sideways movement. Long-term, we remain bullish. Now on to Applovin. Stock jumped 12% post-earnings. Applovin fires on all cylinders at BizBoom's. Wall Street cheers. Q1 results were stellar. Revenue, $1.48 billion plus 40 YoY. EPS, $1.67 crushed expectations. They also announced the sale of their mobile gaming unit to Triple Dot Studios. Translation: no more games, just ads. Game ad steady, non-gaming ads growing fast. Morgan Stanley says non-gaming ads brought in $150 million last quarter. By 2025, they expect $750 million from this segment alone. That pushed their 2025-2026 cash flow estimates up 18 and their price target from $350 to $420. UBS joined the party too. They bumped up 2026 revenue estimates from $5.7 billion to $6.1 billion, citing the early launch of Applovin's self-service ad platform. Advertisers can now create and place their own ads faster and cheaper. Projected ad revenue surged from $348 million to $1.65 billion. Talk about a power-up, UBS warns. Great tech doesn't guarantee instant profits, but early market capture signals major upside ahead. Summary: Applovin is like the AI Tesla of ad tech, focused, fast-moving, and full of potential. Wall Street's bidding up, and we're long-term bullish. Price target for 2.0, last up, HIMS. Stock soared 18% after earnings and is up 27% this week, hitting our $50 short-term target. HIMS earnings boom sends stock flying. HIMS blew away expectations. Revenue, $586 million, more than doubled YoY. EPS, $0.2 vs. $0.12 expected. Active subscribers, 2.4 meters plus 38 YoY. However, Q2 guidance was a bit conservative, $530 to $550 million vs. $565 million expected. But full-year guidance? Unchanged and confident, targeting $6.5 billion annual revenue by 2030. Then came the curveball, convertible bonds. On Thursday, HIMS announced it's issuing $870 million in convertible senior notes. Translation: borrowing money that can later turn into shares. Funds will go toward global expansion, R&D, and possible acquisitions. Investors worried about dilution, but the conversion price is set at $70.6737, above current price, which softens the blow. Investor mood, cautious optimism. Despite a slight dip, investors are still positive. HIMS is growing fast, branching into GLP-1, personalized health, and e-pharmacy. Summary: HIMS is proof that online medicine can be profitable. Since we covered it 2 weeks ago, the stock has nearly doubled. Consider taking profits short-term, but we're holding long-term. Price target, 70. Final recap: Tesla broke above the 200-day MA, short-term bullish. Palantir, likely to consolidate short-term, but long-term bullish. Applovin, long-term bullish, holding strong. Price target for 2.0, HIMS, short-term profit-taking okay, long-term bullish. Price target, 70. If you enjoyed this video, don't forget to subscribe, like, and hit the bell so you won't miss any hot updates.